I'm Tony Kaye, I'm the editor of Eureka Report, and welcome to Property Point again today. I'm joined by Nerida Conisbee, Chief Economist of REA Group. Thanks for coming in, Nerida.
Thanks for having me here.
It's good to have you in the Melbourne studio.
I know, it's so good to be back in Melbourne.
We're normally doing the hook-up between Sydney and Melbourne, so it's great to have you here.
It's a bit easier.
Yeah. Now, just wanted to talk about what's happening in the market, and you were saying before that demand is picking up.
Yeah, so we saw a bit of a drop of demand in December. So we track demand based on the number of people looking to buy and compare it to listings. So in December, we saw a drop off after demand hit a historical peak in October and November, pretty much on the back of banks increasing rates independently of the Reserve Bank. So you would have noticed in November, we saw a lot of banks moving on rates, pushing them up, although the Reserve Bank wasn't increasing rates. So demand dropped off, but really kicked back up in January. So it was almost like buyers saw what was happening in the market, were a little bit nervous, backed off a bit, but then were straight back in January. So it didn't make a huge impact.
Yeah, demand was one of the missing pieces in the puzzle for a little bit, wasn't it? The agents were saying, the market's still strong, but we haven't got enough stock, so it's coming back. Stock
remains a problem. So we do have so many buyers, but we don't have a lot of listings. So one of the challenges with listings is that it's quite sensitive to the level of price growth. So if the market's too weak, people don't sell, but if the market's too strong, people don't sell. So particularly in Melbourne and Sydney, what we were finding is that many people were a little bit nervous about selling their homes and trying to upgrade. As if they sold in, say, September, they tried to rebuy over the next few months, the market kept growing and a lot of people missed out. So as a result, we saw a drop in listings. We also saw an increase in the number of people renovating homes, because that was the other factor. It was a lot cheaper for a lot of people to renovate. So good for the construction industry, but obviously not great for turnover of stock and not great for people wanting to get into the market.
Yeah. And in terms of rates, there's been some funny things going on there, obviously. The Reserve Bank's held rates as expected, but then you've got lenders putting up fixed rates, variable rates on investment loans, some on residential loans. There's some interesting dynamics at play there. Yeah, look,
it is very interesting at the moment. And I think the Reserve Bank obviously kept rates on hold this month. Any movement forward, will possibly be down. I think the economic news coming out doesn't really support an increase. I don't know if anyone's really seriously considering it, but if you can look at GDP growth decline in September, we continue to have low inflation. There's still concerns about the number of the number of people who are looking for full-time work. So all those factors suggest that the Reserve Bank will keep them stable or perhaps cut in the near term. The banks, though, aren't really moving in the same direction as the Reserve Bank. And I think that's the key, that when we look at demand on our site, there is a very, very close correlation to what happens to interest rates. And every time interest rates move up, we have demand drop. And conversely, when interest rates go down, we have demand surging. So I think if the banks continue to raise interest rates, it will have a negative impact on demand.
Yeah. And then we also saw one of the big banks actually say that they're going to stop lending for investment at this point.
Yeah, look, they have been told for quite some time now, for a couple of years really, by APRA to really keep a control on their lending. And it's taken them a long time to react, but they are really reacting now. So, I think it's partly driven by the fact that they have recognised that perhaps if they raise rates, they don't need to get so many new borrowers. So I think that's a bit of a factor. So there's obviously a profit motive there, but it is going to get tougher for borrowers. So it's going to become more difficult to borrow, and it's also going to become more expensive to borrow.
Yeah, so it'll be interesting to see how that plays out across the marketplace. And obviously still strong demand in Sydney and Melbourne. And other markets.
Yeah, look, Sydney and Melbourne continue to be very, very strong markets. And I think if banks start to move rates upwards, then that price growth that we saw last year won't continue. I mean, Sydney increased by 16% last year. So, it's a very, very strong market. Hobart, we continue to see very high levels of demand. So that led to quite strong price growth at the end of the year. So I'm not sure how many people are really serious about investing in Hobart or, the surrounding areas. But we do see very, very strong levels of demand in that state.
Well, we'll keep an eye on what's going on as we catch up next time. Thanks very much for joining us again, Nerida.
Thanks for having me.
And thanks for joining Property Point. We'll see you again next time. I'm Tony Kaye, I'm the editor.